Revenue is not profit, and if you've been treating them like they're the same thing, this one's going to change how you look at your business. Hi, I'm Janie with Sturgeon Bookkeeping. Here's something I see all the time. A business owner knows their revenue number by heart. They can tell you how much came in last month, but when you ask them whether their money actually made them anything, whether their business is really profitable, they're not so sure. That's what today is all about. We're going to walk through the income statement. You'll also hear it called the P&L or profit and loss statement. Same report, 3 names, so don't let that trip you up. And by the end of this video, you'll know the 3 numbers on it that actually tell you how your business is doing. In plain English, no accounting degree required. If you're the kind of owner who wants to understand your numbers and instead of just handing them off and hoping, subscribe, because that's the whole point of this channel. So let's get started. Let's start with the number everyone gets wrong. Revenue is everything that comes into your business before any expenses come out. It's the top line. It's the total of everything you sold or every service you've provided. And here's the mistake. Revenue is not profit. I've seen a business do $500,000 in revenue and lose money. And I've also seen a business do $150,000 in revenue and be very comfortably profitable. The revenue number alone doesn't tell you which one you're looking at. Here's the way I want you to think about it. Revenue is what comes in. Profit is what you get to keep after everything you owe goes back out. These are 2 completely different things. Your income statement shows you the whole journey from that top line revenue number all the way down to what you actually kept. So let's walk down the page together, starting with the very first thing that trips owners up, and it's hiding in how your expenses are split. Your P&L has 2 completely different types of expenses, and if you're only looking at the total, you're missing one of the most important numbers on the page. The first bucket is cost of services, sometimes called cost of goods sold. These are the costs that move with the work. When you do more work, these go up, and when you do less, they go down. So if you're a landscaper, that's going to include the mulch, the fuel, the crew hours on the job. If you're a bakery, that's going to include flour, sugar, and packaging. The more you produce, the more you spend here. The second bucket is your operating expenses. These are the costs of keeping the doors open, whether you did 1 job this month or 100. Your rent, your software, your insurance. Most of these stay about the same no matter how busy you are. Take your revenue and subtract that first expense bucket, your cost of services. This gives you a number called gross profit. Gross profit lives right in the middle of your P&L between the 2 expense buckets. Here's the key. If you don't have enough gross profit, there won't be enough left to cover your operating expenses, no matter what. You can't rent your way out of it. You can't cut software your way out of it. The problem is further back. It's in your pricing. One quick note, not every P&L breaks out cost of services separately. If you're a solo consultant or an attorney, your report might not show the split at all, and that's perfectly normal for your kind of business. Now, gross profit as a dollar amount is useful, but there's a second way to read that exact same number that tells you that something a dollar figure can't, whether you are actually charging enough, and that's next. Want to know if you're charging enough for your work? Your P&L has the answer. You just have to know where to look. We just talked about gross profit as a dollar amount. What's left after cost of services is subtracted out. But there's another way to look at that same number, and it's even more useful. That's your gross profit margin. Margin is just gross profit expressed as a percentage of your revenue. Same number, different lens. And the reason margin is so powerful is that it tells you whether your work is priced right before any of your operating costs even enter the picture. Here's what to pay attention to. If your margin is getting smaller over time, one of three things is happening. Your costs are rising and your prices haven't caught up. You're becoming less efficient at the work you're doing, or both. And here's the part that catches people off guard. Your bottom line, your net profit, it can still look fine while your margin quietly shrinks underneath it. That's why margin is an early warning system. It tells you there's a problem before that problem reaches the bottom of the page. What counts as a healthy margin varies a lot by industry, so I don't want you comparing yourself to some universal number. What really matters most is the direction. Watch which way yours is moving. So we've got gross profit and we've got margin, but knowing what these numbers are and knowing which ones to actually track every month are two different things. Let me show you the three to watch and how to read them together. Most business owners only watch their revenue. These are the three numbers that actually tell you how your business is doing. Now, fair warning, there's a little math in this segment, but it's simple and I'll walk you through every step. Number one is your gross profit margin. You take your gross profit and divide it by your revenue. That tells you whether the work itself is priced right. So let's say you did $100,000 in revenue and your gross profit is $60,000. 60 divided by 100 gives you a 60% gross profit margin. Number two is your net profit margin. You take your net profit, that true bottom line number after everything, and divide it by your revenue. That tells you what you actually keep out of every dollar that comes in. That same business, $100,000 in revenue, and let's say $10,000 made it all the way down to net profit. 10 divided by 100 gives you a 10% net profit margin. So out of every dollar that came in, you kept a dime. And here's how you read them together, because this is where it gets useful. In that example, a 60% gross profit margin is healthy, but a 10% net profit margin means a lot got eaten up between the two. So your problem is in your operating costs, the cost of you keeping your doors open. But if your gross profit margin itself is low, that's a different problem. That's what it costs you to do the work. And if both are sliding, it's usually both problems at once. Number three isn't a calculation, it's a pattern. 1 month is just data, 3 months is a trend. So don't panic over a single month, but don't celebrate over one either. Pull these numbers into a simple 3-column table, this month, last month, the month before, and watch the direction. Now, if tracking this every month sounds like exactly the thing you never quite get around to, I built a free 1-page scorecard that walks you through it, and I'll drop it in the description below. So that's the income statement. You now know what revenue really is, where gross profit hides, and the 3 numbers that tell you how your business is actually doing. But there's one thing this report can't tell you, whether you can actually pay your bills this month. A business can look profitable on this exact report and still run out of cash. And that gap is where a lot of owners get blindsided. That's the report in the next video, and it might be the most important one you're not reading. I'm Janie with Sturgeon Bookkeeping, and I'll see you there.